Here we go. To the inaugural Pensions Summit, preparing your public pension plans for economic downturn. It's sponsored by Public Agency Retirement Services, PARS, and GovInvest. Let's start. Market volatility has been historically high over the past few years. How do you protect your pension funding from the coming downturn? And more importantly, is now the right time to act? We are looking forward to presenting to you today a lively panel discussion to explore these questions and provide you takeaway, actionable strategies to keep your agency ahead of the curve in 2022 and beyond. My name is Charlie Francis, and I am a retired city finance director with over 45 years of local government experience. I was one of GovInvest's early customers, and their pension liability software inspired my policy development that resulted in the city becoming the first city in the nation to adopt a Section 115 trust for pension pre-funding. It was a program sponsored through PARS, the nation's pioneer in Section 115 trusts for both OPEB and pensions. This is a concept that we're going to explore in depth during this presentation. With me today are distinguished panelists, and I will ask each of them to introduce themselves in the order of the slide we are viewing. Keith?
Thanks, Charlie. Keith Brainerd, Research Director with NASRA, the National Association of State Retirement Administrators, and I also serve as a member of the Texas Pension Review Board. Thank you.
Thanks, Keith. Brett Probola, Finance Director at the City of Benicia, formerly Finance Director of the City of Napa. Really have been pushing in both agencies in California to using Section 115, and GovInvest has been a great partner in that, and look forward to talking more about that today.
I'm Ira Summer. I'm one of the senior consultants at GovInvest. I spent over 30 years as a consulting actuary on pension and health issues for agencies all across the country. Got released for good behavior, and then went on to teach finance and economics before coming over to GovInvest.
Okay, thank you. Thank you, everyone. I'm really looking forward to presenting with you today. We will be recording this session, as we mentioned earlier, and we'll be providing all the participants both a hard copy of the slide deck as well as access to the recording after today's summit. And yes, we want and encourage you to participate today. So please do not hold your questions to the end. Use the Q&A or the chat function in the Zoom app anytime during the webinar. I'll be monitoring that. We want to make this as interactive as possible. And here are the topics for today's discussion. It is so important to understand pension plans, liabilities, and why there is so much rate volatility. And then we will provide insights into the risk exposure of pension plans when discount rate targets are mismatched with future expected returns. Well, with that, how do you go about creating a local government funding policy for stabilizing long-term financial planning? And finally, what tools do you need in your arsenal for both policy development and execution? So let's start this off with you, Ira. When the total amount of benefits owed to all current employees and retirees exceeds the value of the financial assets the pension plan manages, then there's an unfunded liability. How do actuaries calculate the liabilities?
Well, the goal of pension funding is to make sure there's enough money in the plan to pay for all the promised benefits. So what actuaries are doing is taking the information about the benefits you promised and your people based on who's in the plan now or who's ever been there before, and basically figures out how much is going to be paid, taking into account how long they expect people to live, when they expect people to retire. The goal of the funding is to stretch it out from the time they get hired until they retire, so that the cost for each year should be consistent. That cost they call the normal cost. And you see here, it's a combination of employee contributions and the agency's normal cost. At any point in time, we take a look and see how you're doing, if you're on track or behind track. If you're on track, the target that you're looking for is called the actuarial accrued liability. And if your assets are there, you're 100% funded. If things go differently, because somehow the world doesn't listen to the actuarial community, then you end out either ahead of target or behind target. If you're behind target, you have an unfunded actuarial accrued liability. and that gets added so you can catch up over time.
So Ira, if I had an S&P 500 index in front of me right now, the that unfunded liability is changing second by second. It's kind of introduces a lot of volatility in there. So Keith, the value of the financial investments that the pension plan manages, it's constantly changing, right? How does that affect the pension rates that agencies experience, and why is there so much volatility from year to year?
Well, most volatility occurs from two different factors. One is variation in the plan's actuarial experience from assumptions or expectations. Of course, life does not unfold in a straight line, and people live longer, they retire sooner, investment markets go up and down. All of these different factors result in volatility of the plan unfunded liability and also the cost. In addition, plans periodically adjust their actuarial assumptions and sometimes their methods. And typically when an actuarial assumption is changed, that will adjust the cost of the plan and promote volatility as well.
Okay, I'm
And-
going
and
to.
In fact, just to sort of reiterate what Keith is talking about, looking at plans all across the country, we've noticed that 80 to 90% of current unfunded liability is either due to changes in assumptions, making them more conservative over the last couple decades, or to adverse investment experience, where things, the experience of the plan didn't hit the targets because of the ups and downs of the market. So very often when people see unfunded liability, they want to blame somebody. They want to say, oh, somebody in the city council's to blame, or the state. But it's not always that. It's things, sometimes, very often, things outside of your control, and just trying to adjust to the current world.
We've got some questions coming in already. Thank you, audience. One of the questions, the first one was, is UAL always a bad thing? And then there's a follow-up question about, are we going to be addressing pension obligation bonds, or thoughts about bonding these liabilities over 20, 30 years? So what is, Ira, is UAL always a bad thing?
No, not necessarily. I mean, it's a normal thing that's going to happen because, as Keith mentioned, the world does not unfold in a straight line as the actuarial assumptions expect them to be. So there are going to be ups and downs, and being ahead of target or behind target is not necessarily a bad thing. The part of the question is, are you trending in the right direction? Are you improving your funding percentage in general from year to year? Because it's going to be going up and down, but in general, you're moving in the right direction, and the unfunded liability shouldn't be too big. It's one thing to be 90% funded because you're relatively close to where you're supposed to get. It's another thing to be 40% funded, because that's going to shoot your costs up through the roof and put you in a position where it's going to be really hard to recover. One of the things that we've seen are contribution rates for pensions that are bigger than salaries. And that just is not sustainable over time.
Mm-hmm.
We, from the public policy perspective, educating the public and your councils on UAL, I think, is as important as understanding your level of funding, as Ira mentioned, and the importance of not being too overly unfunded, I guess. For me, has been important in every agency I've been in, is the education of council and the awareness of what the UAL means to not just your annual budgets, but what it means for your ability to get closer to that needed funding level moving forward.
And making
really
sure you
the
have
more
a
important-
plan in place to take care of it. And then you follow the plan.
The more
And
important
there-
factor is having a plan to be able to eliminate that UAL over some period of time, and making sure that UAL is manageable. Back in the day, 20, 30 years ago, when there were a lot of plans that had no unfunded liability or were even overfunded, there was a lot of pressure to increase benefits, which creates a challenge by itself. And I know that there are some public pension plan administrators and trustees that are just as glad to have a relatively small UAL because it relieves them of the pressure of having to explain why benefits are not increasing.
And Keith makes a great point. In California specifically, I mean, we were 100% funded, in the early 2000s, and decisions were made, and actually probably late 90s, to do exactly that, enhance the benefits, thinking that that growth is kind of going to go forever. And now California sits in a not unmanageable predicament, but a much more difficult predicament than if we would have taken a little bit more conservative approach moving forward with that. I think many cities and counties would be having less stress today, and the state included, if we would have looked at that a little bit more conservative and not really raised the benefit, because, you know, I think at the time they just thought that growth would be kind of in perpetuity. And then of course we hit the Great Recession and it just completely collapsed. So I think that's a really valuable point Keith makes.
Yeah, there's one of the follow-up questions talked about the huge burden on current generation of taxpayers, meaning less money for parks, senior programs, public safety. We're going to talk about how do you go about developing a plan later on in the webinar. But did anyone want to make a comment on pension obligation bonds now?
So we looked at them recently in the city of Benicia, only because, so I personally in my career felt like they are an instrument that can go really bad really quick for most agencies. But with interest rates at the level they were, we did look at them. The city of Benicia has two that we did a while ago, and I'll be very honest, those at the time penciled out, I think, but loosely, and they are right now not doing anything terribly negative, but they're not really doing anything terribly positive for us either. It was kind of a wash. And so my experience has been, if interest rates are as depressed as they were 2 months ago, we'll say at this point, and I think there is maybe benefit from my perspective. As interest rates rise, I think that becomes very hard to really see value without the risk reward being unbalanced really significantly for a governmental agency. And so I have great concerns with them now as we look at interest rates, even 2 months later, because of the significant shift in what you can get a POV for in the market.
Great. Okay, let's move on to the next one, is that market performance. Dennis Mullins, I'm going to move the questions over to you. What is the outlook for expected investment returns over the next, say, 1, 5, 10 years?
Well, after Charlie, we've just experienced a 5-year run where the S&P 500 increased more than 18% per year, and really helped out in the adding to the market value in a lot of these pensions. It's the outlook for the next 5 to 10 years is not as rosy. And if you look at what most asset management firms and what most large pension plans are looking at for the next 5 years, it's quite a bit lower than the returns we've seen. And since a large portion of the market value increase of pensions has come from investment returns over the history of the pensions, that's very concerning. So it looks like it's going to be quite a bit lower. I'd have to say that the average that from the capital markets assumptions that I've seen for the market itself over the next 5 years, high single digits appears to be something that we'll be very happy with.
Wow. So you actually had a couple slides on that. Should I move on to the next one?
Yeah, go ahead. And, it's a pretty broad topic. So, I mentioned returns have been above trend for the last 5 years, over 18% a year. And if you look at, I've got quite a few of the benchmarks on the left-hand table here for the past 5 years. Mid-cap stocks, small-cap stocks, non-US stocks, even bonds have produced pretty good years. The US aggregate bond index, 3.57% per year for the last 5 years. Over the next 5 to 7 years, again, we're looking at some pretty low rates of returns. And this would suggest that that anybody overseeing, these pension plans would probably want to sit down and acknowledge that we're seeing lower projected returns and see if any action is warranted on investment policy or portfolio structure.
And what do we
if you do change your portfolio structure, if you set yourself up to protect against some of the downside, if you lower your risk, then your expected return is going to go down with it. Which means, and the basic funding concept underlying pensions is, money in equals money out. So if more money is coming from contribution from investment return, less money needs to come from the city and the employees, but vice versa.
Yeah.
If less money is expected to come in, then contribution rates are going up and you're going to have to pay more.
Exactly. And that is the challenge that's laying before us. So you raised a very good point that I want to comment on pretty quickly. When we look at de-risking a portfolio, historically, that has meant reducing the stock exposure and generally moving those assets to bonds. And we're at a point right now with bond yields being very low, right? The 10-year treasury this morning is 2.2.5, 2.7 maybe. And so we're not getting an awful lot of yield off of the bonds. And yet bonds are very risky right now as we're in a period of that's assumed to be generally rising interest rates. And so we're in a period right now where the greatest risk may actually come from what have been considered to be the lower risk securities. So we talk about your best opportunities in a pension plan, maybe for some of those that might be a little underinvested in equities, to risk their portfolio up with a higher risk exposure, higher equity exposure. And it doesn't necessarily increase the risk. If you look at historical returns and patterns, you might conclude that that would increase your risk. But again, we've got to make some educated guesses going forward. And if bonds are yielding very low rates of returns and interest rates are rising, then bonds may actually be the riskier place to be in the future.
Dennis, what do you think about the fact that with higher interest rates, PE ratios tend to come in, right? Would make equities a little bit more difficult, but also with the overlay of a lot of the ESG investing that has to happen. Does that create a risk in that we're going to kind of consolidate all of these plans into specific investments and have too much consolidation and very few investments because of all the policy expectations of the type of investments we do in the future? Or is that negligible because there's just enough to spread it out?
Well, it's very difficult to measure because it's hard to say how many of these investment decisions are being driven by purely asset allocation decisions and how many are being driven by ESG considerations. Mm-hmm. But the good news is that in the past, ESG investing has sort of led us down a path where we're changing the investments and we're going to in specific companies, specific funds to meet our ESG goals. The good news is that almost all mainstream companies now are taking an ESG approach on their own. Mm-hmm. And so ESG investing will eventually just overlay with investing in general. So we probably shouldn't see too much of a concentration effect there.
Okay, for those people in the audience who don't necessarily speak investing, can you explain what ESG stands for?
Yeah, thank you. ESG investing is environmental and social governance investing, and it's generally encapsulating what used to be called SRI, socially responsible investing. And again, in the very early days, this was done kind of on a company by company basis, very simply screening out companies. I don't want to own any of these companies. And that was very easy to accomplish. Now the mandates tend to be a little more broad in nature. We only want to invest in companies that have environmental goals or social governance goals similar to ours, or we only want to invest in companies whose boards are made up of a diverse group and who have policies in place regarding employment practices and paying a living wage. It becomes much more difficult to screen companies out as the objectives are stated in a more broad sense. But again, ESG is going mainstream. So at some point in the future, general investing is probably going to align with ESG investing.
Right, we have some questions that have been coming in that are kind of actuarial questions. So I'm going to put those on hold until we get to another slide. And so I just wanted to let those two people know that I've seen your questions and I'm going to get to them. Is there anything you want to comment to on this slide, Dennis?
Yeah, let's cover this real quick. I mentioned that forecasted returns are lower than what we've seen in the past. And in the upper left table on this chart, it's pretty busy, but I've taken capital markets assumptions that are published for a couple of very large investment firms. I started with my own firm, US Bank, but then I've added Invesco, Charles Schwab, Vanguard, BlackRock, Fidelity, JP Morgan. These are the 5 to 7 year return expectations for large cap US stocks for the next 10 years. If you look at this, 3, 5.4, 6.4, 3.2. BlackRock, kind of an outlier, 6.2, but Fidelity, 3.1. These are much lower return averages than we've seen in the past. And also notice that the bond expectations are very, very low.
Yes.
These numbers are all below the current 10-year Treasury yield. And that means that pretty much everybody's factoring in some market value decline in bonds. I've graphed the return and the risk expectations along the bottom here, and you can see quite a few pretty low expected returns. Not a big difference in risk from one portfolio to the next. Or I'm sorry, not a big pickup in return expectation from one portfolio to the next. But I also graphed historic returns up above, and you can see using the vertical axis, you can see that returns for 45% equity, 61% equity, 73% equity portfolios were quite a bit higher in the past than what we're expecting.
Wow. So this leads us back to the actuaries. Ira and Keith, I'm not hearing Dennis talking about expected returns that match the 7.6% national average of pension plans discount rates. What does that mean for the additional risk that a pension plan must undertake to achieve these investment returns that match the discount rate?
I'm not sure they need to match them in the short term. A pension plan is designed to pay out over the lifetime of the employees, all the way until they're retired. So it's a 30, 50, 60-year commitment. So you don't necessarily have to take all your money and buy Powerball tickets to try and match the returns in the next few years. You need to make it through to get to a reasonable longer expectations. So you need to realize you're going to fall a little bit behind in the next few years. And along with this probably comes, this probably means we're also going to have some tough times economically, which means that agencies' revenues may be expected to be going down over that time period. And one of the tough things about pension funding is when the markets go down, the actuaries ask for more money. That's usually when the city doesn't have the money. So now when revenues are stronger for some agencies, this becomes the smart time to start planning, to start putting extra money away, whether it's directly to the pension fund to get ahead of target or into something like a 115 trust. So you got it as almost like a rainy day fund for what we're expecting to see are really tough times. The only optimism I have from all this is, having worked in this industry for not as many years as Charlie, but way too many, is when there's a consensus from all the investment experts that the market's going in one direction, that's usually when we see it go in the other direction. So I'm hoping everybody's wrong once again, and then we'll live through this.
Okay. Hey,
It's helpful to keep in mind that most public pension funds still have unrealized gains from the last few years. There's a lot of investment gains that have yet to be booked actuarially, which should provide a little bit of relief, at least for the next 3 or 4 years. And meanwhile, we've just finished a decade of just about all public pension plans have reduced their investment return assumptions. So the overall level of return assumption right now is below where it was. And I suspect we'll see a continuation of that trend toward lower return assumptions.
Okay. We have some questions coming in now that I think this is a good time to address. Michael asks, do we know what the expected inflation is going to be over the same time period that Dennis just outlined in his expected returns?
Simple answer is no. We don't, it would be much harder to forecast a general inflation level. It'd be a tough thing to do, but no, we don't, we don't put an awful lot of effort into that. We don't think we have an edge in trying to forecast, what inflation's going to be.
And a comment came in that said capital market assumptions have been consistently wrong per your 5-year statistics, Dennis. So is there a better way to set expectations?
Yeah, good question. That's not a direct comparison there. That's not the 5-year returns compared to what we were forecasting 5 years ago. So that's the 5-year returns compared to what we're forecasting now. But I think the question is still valid. It's not so much that we're saying that in the next 5 to 7 years, stocks are going to return 3.82% or whatever our forecast is. I think the takeaway message from this is across the board, returns are expected to be lower. We've been above trend for a long time. Now we're going to be below trend. So instead of 3.8, is it going to be 4 or 5? Is it going to be 2 or 3? I think the key takeaway again is that it's going to be lower.
Okay. And then some actuarial questions came in that we might want to talk about. Sarah asks, what are target ratios that help know the health of our pension? So like her percentage of liability to covered payroll is 27%, and her fiduciary net percentage is 80%. And her city council is asking, how are we doing? And she doesn't know what the benchmarks should be. Keith, can you give us some help on that?
Well, I'm not a professional actuary. The metric I use is whether or not funding the plan now and in the future is causing fiscal distress. It's okay to have an unfunded liability. It's okay to have a cost to amortize that unfunded liability. The important thing is that the plan be moving in the right direction, that the plan's actuarial assumptions and methods are sound and reasonable, so that the plan is moving toward eliminating its unfunded liability over some reasonable period of time, ideally less than 20 years. So it's easy to get caught up in these ratios, but I think sometimes these ratios can generate more questions than answers.
So, okay, thanks. Bob is asking a question about, it's an actuarial question. I think it's a good question, helps us understand how these liabilities are being calculated, but he's asking, like, I got a first-year firefighter who's making $50,000. His promise is to give him 80% of his average earnings over the highest 5-year period. But by that time, he's going to be a fire chief earning $200,000. There's no past service cost. So how is the normal cost calculated? Does it capture this in the assumed payroll increase that, eventually this firefighter might be a chief?
It should, if your actuary is doing a good job, the possibility that the expectation is that this person is going to be moving up through the ranks across time. Not everybody makes it to chief, but somebody will, and that's built into the expectations over time. So the purpose of funding is to figure out where that person's going to be on the payroll scale when that person gets to retirement, and base the total pay that you're funding on that. So it should be taken into account.
Oh, okay, great. Another question coming in is, did the COVID affect the mortality tables?
Oh, that's a yes and no. I mean, the first question is, did COVID affect mortality? And in the short term, it absolutely did. In the long term, we're not sure. And so over time, the actuarial community tends to be a little bit slow in pulling in new information just to be sure that it's all there. So new actuarial tables are looking at this. Over time, the results from the COVID era, which I hope is close to over, will be blended in with everything else, and there'll be new life expectancies. But right now, it's a wait and see.
Okay. And before one more before we move on, let's talk about closed systems. So in other words, if I closed a legacy tier and put in a new pension tier, should we be changing the matching Should we change the discount rate? Should we change the matching of a rate of return, to something more conservative?
No one else?
Generally, yes. It depends on the overall working life expectancy and life expectancy of your population. But if you are closed, if you're not taking in new members, gradually your investment horizon is declining, and you're in a position to take fewer and less risk.
Okay, great.
Right.
Thank you.
And as you get that plan, if you can get that plan to a place where you are 100% funded, where you cover the liabilities, you want to protect that because you don't have employee contributions to cover them once those people have retired. So you are going to want to lower the risk, protect the funds. That lowers the return expectations because of the shorter time horizon.
Okay, thank you. All right, let's move on. I'm going to cover this funding matrix in a minute, but I want to start with Brett. Let's bring all of this back into long-term financial planning. Many of us on this call today are finance directors. How did you think about preparing your long-term financial forecast when you have all this volatility in your pension costs?
Yeah, so the first thing we did, and I mentioned earlier, is you have to educate your councils, and it may seem redundant, but when you get new council members on, educating them about pension in general, whether that's pension 101s or more comprehensive reviews, if they are a little more long-standing councils and boards, I think is step one and most important before you even get into the fiscal conversation. The next piece is really then, we took into account in our 5-year forecast kind of the general assumptions that everyone's talked about, but we also took into account and added a layer of kind of what would be our expectations with pension. For us, we looked at it as a balance between maintaining a certain percentage of total general fund cost in our pension side versus being able to address and increase our total funding so that UAL is lowered effectively. And the reason we did that is council really had a focus in dialogue with them about ensuring that we meet the obligations to employees on the pension side, but not allowing it to become such a great proportion of the general fund that we lose significant service delivery that we need to do to the community. And that balance really is where we created the idea to create a policy around how we deal with pension and funding it, but also creating the Section 115 trust. And that's where kind of this partnership that we've used here and when I was at the city of Napa with PARS, who manages our Section 115, and how we invest it relative to then the work we did with GovInvest and the projections and developing the funding policy to assume, okay, what would be our uses for it, right? If we grew that Section 115, and we kind of came up with 3. One was we would use it to specifically look at tiers that we could close out, for lack of a better word, that were legacy tiers that we could fund, that would take out some liability moving forward. We talked about potentially dealing with bonding and how could it help potentially help pay for debt service related to POBs if we were to do them. As I said, not my favorite idea, but we wanted it in as something to look at. And the third is under fiscal stress, how would we be able to use this fund to make sure that we can manage through times of instability, I think as Ira mentioned, where revenues are down and pension may become a larger piece of that, and kind of ensure that we kind of artificially cap that percentage relative to our general fund and to ensure that service delivery side is still met. And so when we had those uses goals, we then kind of, the last piece was, okay, what's the bucket? What's the number we want to try to get to in a range within our 115 that would really allow us to, in the time, specifically in California, as the kind of pension curve is rising for us before it kind of tips over, how can we grow that fund and have a policy that funds it and an investment strategy that allows it to grow enough to be able to use it at the most valuable time to cut that hill off, instead of just kind of doing it for so long that we're already coming down and it has less benefit to us. And so we kind of took all of that into consideration when we made the policy, and then look at that when we do our long range planning to make sure that we're making strategic decisions that keep that front of mind as we move forward, and it doesn't become an afterthought of how to deal with pension, but it's an active part as much as our CIP plan or anything we're doing from a policy, strategy, operation perspective year over year. That kind of pension policy conversation is one of the few things we will always discuss as a piece of it, because we understand how quickly it can get out of control if it isn't managed over time. And so that's been very successful, again, both in the city of Napa and now here in the city of Benicia.
Okay, thank you, Brett. You know, we're getting a lot of questions about continuing education credits, CPEs, and yes, we will be issuing certificates next week for CPEs, and we're tracking attendance. There are no polling questions, but we do know you're here. I want to cover this really quick. This is how I go about helping our customers develop a pension policy. The first element of a pension funding policy is articulating the funding goal of the policy. And usually I recommend an acceptable range as a target funded, like 90 to 100% or 80 to 100%. And the percent funded a plan, of course, is calculated by the total assets divided by the total liability. And the lower end of the range I call the floor. And if it's not met, if the floor is not met, then the funding components section of the funding policy is required to be invoked. So in general, the higher the floor, the greater need for additional funding to be dedicated towards a proactive pension contribution, which could require structural adjustments like revenue increases or expense reductions, and these would have an impact on service deliveries. And the second element is the time frame. This represents, the time frame to meet the desired funding level in the context of the many variables used in actuarial analysis and calculations. So the scenarios of additional variables include, but they're not limited to, things that we've talked about: demographic changes, the shift of a workforce from mostly legacy members to new pension tier members, mortality estimates, workforce size and tenure. The shorter the time frame, the greater there might be a need for structural adjustments to achieve the goals. And then we look at the funding components, and these are the actions that would be required when the funding floor is not met. And these scenarios build on each other. So under scenario 1 and 2, you have the elements in scenario 1, and then there's additional elements in scenario 2 that include the scenario 1 elements. So they build on each other as you look at different scenarios and choosing which funding policy you want. This element, the allowable uses of the funding policy, describes and details the allowable uses of the funding generated. It depends on the ultimate policy goals, and there's further refinements that could be made, like in your investment strategy. Service delivery outcomes, it's really important to outline this for your local government on what its structural adjustments will necessitate service delivery outcomes. And then, of course, if there's any structural adjustments, there's going to be additional impacts on your government's fiscal sustainability. And this element begins to articulate the scope or the magnitude of the structural adjustments necessary to achieve that goal. Okay.
So Keith, do you want to talk a little about some of the things that are happening in Texas with funding?
Well, in recent years, the Texas legislature has passed a number of measures that are intended to increase transparency and reporting among public pension plans, and also that have required now public pension plans that fall below a certain threshold in terms of their amortization period and now their funding period to come up with what's known as a funding soundness restoration plan. And so if a plan is falling short by designated metrics, that plan, and now along in concert with its plan sponsor, the city or the county or whoever is sponsoring that plan, is required to develop a plan to reach full funding over a designated period of time, typically less than 20 or 25 years. That, in addition to a significant increase in reporting on investment activity, investment performance, the managers that are being used, the fees that are being paid, and so forth. So there's been a lot of movement toward more transparency and getting plans moving in the direction of reaching full funding.
Okay, thank you, Keith. A couple questions came in. And this is a question, it's kind of like a follow-up from a previous question. It's for the percent funded goal. in this policy matrix, what considerations are needed to see what the right level is for an organization? How best to articulate the reasons for, contributing faster than the required contribution? And went on to say that most cities don't have excess cash, so the funding competes with other needs. This is something I think you addressed earlier, Keith. I mean, if you could be 20% funded, but if you have a cash flow that supports all your service level needs, you might not be in bad as shape as someone who's 80% funded and doesn't have enough money to pay for police officers on the streets.
I think the most important element is that you have a plan that you can afford, that's reasonable, that's going to get you to full funding or something close to it over a reasonable period of time. And you have to take into account a number of factors, including the reasonableness of your actuarial methods and assumptions, your expected cash flow, the fiscal integrity of the plan sponsor or plan sponsors, and also the ages and work-life expectancies of the workforce. So this is work for an actuary.
Okay.
Well, and the thing is, even more than that, the type of agency that you are may determine what makes sense. Most agencies, you're going to see that their personnel costs, including pensions, take up 80, maybe 90% of their budget. For those agencies, you need to keep your costs, a percentage of that, more controllable, lower. On the other hand, if you are very capital intensive, so your payroll and even your pensions are only about a third or a half of your costs, you've got more room in your total budget. The cost may seem exorbitant in relation to your payroll, but in terms of your total budget, they're very controllable. So it's going to shift over time. I think the important thing to keep in mind from this question is pensions are rarely the number one priority for any agency. So when you if you get money and you're just reacting to that new money coming in, pensions will very seldom get that money. But if you set the priorities early and say, we're going to need to take a certain portion of all new monies that come in, all extra money that comes in above expectations, and set it towards the pension, then you won't be spending it on other things right away, and you'll remember where it is in the priority list.
And Ira brings up a great point. So in the city of Benicia, we just recently passed fund balance policy. So at the end of the year, unassigned fund balance, 10% automatically has to go towards pension. And so we did exactly what Ira is saying, is that we've made it an automated process and actually created a super majority requirement to change it with our council, so that priority is kind of automatically maintained. It doesn't become a political football, because the way we created the policy makes it kind of a stronghold and shows the priority that our policymakers have put forth. And I think having those kind of structures, as Ira mentioned, makes it easier to try to gain funding for it, especially because, in any political environment, extra money means definitely everything but pension in most cases with our policymakers. And so, getting those foundational policies built, I think is vital to being able to fund anything moving forward.
Okay. We have another question about a trust, and I want to answer it, but I want to ask you a follow-up question first, Brett, and then I'll move into what a Section 115 trust, and then Kurt, I'll get to your question. So tell us, you set up a Section 115 trust to pre-fund your liabilities. What did it do for you versus just setting aside money into your general fund?
Yeah, so we have a lot more flexibility with PARs in the way we invest relative to our treasury pool. And so for us, we are still very much in a growth mindset, trying to reach that range I talked about in our 115 to be able to maximize its use. And so, sitting down with PARs and really explaining that is the place that we are in as it relates to our funding mechanism for pension, we were really able with them to be more aggressive. We felt it was appropriate to try to accelerate that, again, to reach a goal of a funding level. So as that pension is increasing for us in California with PERS, we would be able to kind of help cut that hill off for us as an agency, kind of maintaining that artificial ceiling, as I talked about. And so having that separate from our treasury pool and just being in our general fund treasury pool really provided a lot more flexibility and really allowed us to kind of enhance that pension funding separate and distinct from just kind of letting it sit and grow at a much more, slow pace on the treasury side of our investing.
Okay, thanks, Brett. So we've talked a lot about Section 115 trust, and I just realized we haven't really talked about what a Section 115 trust is. So let me give a definition of it. A Section 115 trust is, well, first, Section 115 refers to the Internal Revenue Code. And in that section of the Internal Revenue Code, it states that income generated by an investment fund that is established by a government, and it's established by a government to hold revenues in excess of the amounts needed to meet current expenses. In other words, the gross income of a trust. And the Section 115 says it's excludable as gross income for income tax purposes because it represents an essential government function. So this is really important that the IRS said you can set up a Section 115 trust and the income from it is exempt from taxation. And furthermore, it says that it is exempt from taxation because it's a governmental function. And so therefore you can invest it in a more diversified manner than you could by government code in your that's governed if you put it in internal services fund. Those monies that are placed in a Section 115 trust by their very nature of the Internal Revenue Code are irrevocably committed for the essential government function that's specified. And IRS has deemed through private letter rulings that post-employment benefits and pension benefits are essential government functions. So in other words, all this monies can be placed in a Section 115 trust. They can be invested for the purpose of earning income. They can be diversified in a manner that can earn conservatively more than investments governed by your state's government code. And furthermore, GFOA recommends that governments pre-fund their obligations for post-employment benefits, OPEB benefits, if they have a long-term liability. And many governments now are setting aside money for pension pre-funding, as we've talked about through this whole webinar. There's no cost to set up a Section 115 trust. And so this is something that you should have in your toolkit so that your elected officials can develop policies that address tomorrow's pension realities. So to get to Kurt's question, he lives in a small Massachusetts town containing 400 residents. The town has only 3 employees. The town belongs to a county retirement program, and he's a new select board member. And he doesn't know what benefits were promised to employees at time of hire. So the town wants to be fair to present and future employees. Whoops, my question went away. And so he wants to know, should the town set up a trust to cover additional benefits such as healthcare, vacation time, or set aside funds in a stabilization account to pay employee benefits on a year-by-year basis? Would you recommend hiring an actuary or discussing with the town attorney? So I'm going to start and recommend that, coming back to this slide, Section 115 trusts are no cost to set up. So you should set one up, and we can contact you about the process of doing that after this webinar. And then we provide consulting services to walk you through these questions of whether or not setting up the trust should be done in a stabilization account or not, and work with you on that question, Kurt. Anybody want to add to that?
Yeah, I mean, on the question of an actuary or an attorney, the answer is probably yes. Yeah. Because you want to find somebody who really has expertise in this area to help you through. First of all, you're saying you're not sure what the benefits that were promised were. Find out what they were. Have somebody do that, because without knowledge, you're not going to be able to move forward. But then find somebody who's got experience dealing with situations like this. And more often than not, it's going to be the actuaries and the attorneys. But there are often attorneys who are very experienced in this area, who work with other towns with similar situations. Find one and have them help you through.
Okay. All right. There are tools for policy development. And Kristen, can you tell us about how we can model scenarios to help our elected officials make informed policy decisions supported by data and evidence?
Absolutely. Thank you, Charlie. So, there are these innovative finance tools that we've been talking about today, the 115 Trust, but there's also pension analysis management software that makes that analysis process very measurable and manageable for you and your seat. So traditionally, pension analysis processes are very costly and time consuming. So if you're working with a traditional actuarial firm, each report could cost tens of thousands of dollars. It's a lengthy process from hiring to completion of that report, and then you don't really have that ability to run real-time stress tests anywhere. So plus, once you've got that report, it's really challenging to break it down for elected officials and other stakeholders, which often leads to deprioritization of action on liabilities and also increasing cost. So that's where this visual software comes in. It's customized specifically for each agency. GovInvest pension management tool has been created by certified actuaries. It's supported by actuaries in-house and trusted by government finance professionals across the country. What it does is it allows you to run unlimited scenarios that can be saved for future reference. And now you have a historical archive, so there's no loss of institutional knowledge when roles transition at the agency. Also, as a sole source provider, GovInvest team partners with our clients to run analysis, as well as generate policy and scenario reports for the client when needed. This is just one way that we work with governments. We have other tools in our financial forecasting suite, but we really want to empower you to bring your data to life and make informed decisions with confidence.
Thank you, Kristen. Anecdotally, before GovInvest, I had to pay an actuary to run scenarios for me, and I had thousands of questions. And when I was going through my pension and OPEB reform policy back in 2015, the actuary would say, "Oh, that'll be $5,000," and "Oh, it'll take me 2 weeks to get to it, if I get to it at all." And it was just driving me crazy. So when I had the software, now I could run all the scenarios I wanted, recommend a policy to my elected officials. Visually, they could see the impact of that policy, not only in recommending it, but years later when I could show them the results of their policy. So tools like this provide the data and evidence that supports good policy decisions. Thank you. Thank you, Kristen. So now we're getting to the key takeaways. We have all learned that we live in a VUCA world. And what do I mean by VUCA? It's full of volatility, it's uncertainty, it's complex and ambiguous. So we have to have a VUCA response. That means we have to have a vision of the future we want. We need to understand the interconnections in order to think and plan strategically. We have to have clarity to focus on what counts, and we have to be adaptable. In other words, flexible, agile, promote a consistent culture for making good decisions and to facilitate innovation and build up resilience. That's what I mean here. Policy development and execution is essential when you're addressing your pension and OPEB liabilities. And finally, we shared with you the tools that you need to have available: a Section 115 trust and data and analytical models. So let's get to our questions. I do have one last minute question from an audience member. And then put in your chat if you have any additional ones. This question is from Michael. He says, to make it more appealing for employees to make a payroll contribution to an OPEB PARS fund, is there any mechanism that their contribution could be tax deductible? So when we talk about Section 115 trusts, the contributions aren't necessarily coming from employees, they're coming from the employer. In other words, the employer is setting aside money today to and just by its very nature, because you're a government, that employer contribution is exempt from taxation as well as the income in the trust. So, and the trust is used to set aside money for funding your pension system, not for employees to receive pensions from that trust.
Although on the OPEB side, the benefits are being paid from that. It's not common for employees to make contributions while they are working towards their OPEB, their retiree health benefits, but it's happening more and more often.
Yes.
I don't remember off the top of my head the tax deductibility rules related to it, but if it's not tax deductible, what some agencies at least used to do to get around that is to very basically lower pay by, let's call it 1% of payroll, and have the agency stick that money in. So it looks like it is officially employer contributions rather than employee contributions, but somehow you are announcing to the employees that you're doing it in lieu of pay, so that they realize that they are taking part in paying for this whole thing.
Okay. All right. We only have 1 minute left.
That ringer is not off.
The question came in, can I do one Section 115 trust for both OPEB and pension? The answer is yes. We have two last questions coming in. Did I hear correctly that a Section 115 trust could be utilized for compensated absences liabilities? And I don't know the answer to that. Do you?
I would say not directly. I mean, you could do a fancy thing where you take some of your 115 trust to pay your annual retirement costs, and that allows you to free up money to be able to deal with compensated absence costs, and you're effectively washing it legally. But directly, not in my experience. Could you?
Right. The money from the 115 trust, if it's a pension 115 trust, the money has to go into the pension fund to pay for pension benefits. If it's an OPEB 115 trust, the money has to be used to pay for the retiree health benefits or the other OPEB benefits. And the absences or the vacation time or other things like that are not OPEB benefits.
Right.
They're employee benefits. They're not post-employment benefits.
Right. Okay. One last important question. My OPEB liability is 77% funded. The actuary has a negative contribution amount on the funding schedule. This seemed odd to me, and my accountant says the discount rate can increase if we do not contribute annually. Can you give some insight? Is that something we should address Karen with directly, or should we try to answer it now since we're out of time?
Just very quickly, there are no such things as negative contributions.
Okay.
So you need to watch what's going on. Sometimes things look like negative contributions because the total required contribution to the plan is less than the benefits you're paying out, and you may still be paying your benefits from the general fund plus making additional contributions to the trust, so that it looks like a negative contribution. But there's no such thing as negative money.
Okay.
I don't know if any of you have seen negative money. I don't know what happens with Bitcoin or any of those other weird things, or NFTs. I still don't know what those are, but no negative money. That doesn't happen.
Okay. So Christian, yes, 115 trust funds can be used to pay for current retiree OPEB benefits. And with that, I want to thank all of you for watching today, for participating in our first annual session, the first session. I also want to thank all of our panelists today, Ira, Keith, Brett, Christian, Dennis. Thank you for your insights. Thank you for your contributions. Please reach out to us for any follow-up assistance you